This presentation does not seek to predict whether AI will succeed or fail. Instead, it addresses a risk management question. How do AI driven shocks travel through financial markets and reach our bank? We begin by identifying four connected risk clusters. First, valuation and bubble dynamics. Parts of the AI ecosystem are priced on very optimistic expectations, with interconnected investment flows reinforcing these valuations. Second, energy and infrastructure. Data center demand is rising faster than the grid capacity itself, creating delays and cost pressures. Third, cyber and model risks. AI systems can fail silently, producing incorrect outputs before the problems are detected. Fourth, macro and policy transition. AI investment can keep inflation and interest rates higher for much longer, while regulation and chip supply concentration add further pressure. The key point here is that these risks do not sit in isolation, but rather they reinforce each other. The next slide will show how these transmissions happen. Building on the risk drivers, this slide shows how AI shock transmits through the financial system. Think of it as a chain from the top to the bottom. At the first order, the triggers already exist: elevated valuations, infrastructure constraints, and also model risks. At the second order, these translate into the macro and market conditions that the bank can ignore. AI investments can keep inflation elevated, which keeps interest rates higher for much longer, while the shifts in sentiment also widen the credit spread and increase volatility. At the third order, this becomes financial market stress. The higher rates and wider spreads make refinancing more expensive, particularly for AI exposed firms. At the same time, funding conditions tighten and technology asset prices decline across the sector. Finally, this reaches the bank balance sheets. Credit risk rises as borrowers struggle to repay. Market risk emerges from market to market losses, and liquidity pressure builds through margin calls. Operational and reputational risks also increase if systems fail. The key point here is that this is not a linear issue. These effects reinforce each other. The spreads widen, then it tightens the funding, the defaults rises, and then stress amplifies across the system.
Scenario 1 is core systemic stress case. It runs in three phases. In phase 1, confidence break in equity market. AI firms trade at very high valuation multiples, and if revenue growth disappoint, investors begin to reassess the long-term AI growth assumptions. So equity valuation comprise and market shift towards a risk-off environment. In phase 2, the credit market follows. Equity decline increases the perceived default risk, leading to a widening credit spread. Companies across AI supply chain face refinancing pressure. In phase 3, inflation rates stay elevated. Borrowing costs increase, investment slow, and creating pressure on banks' balance sheet. So the bank's risk profile change. Credit risk become dominant, market volatility increase, liquidity pressure increase, and exposure across AI-related sectors become more correlated.
Scenario 2 is a physical constraint with financial outcome. Data center electricity demand is growing far faster than grid infrastructure can adapt. Government research estimate demand could rise 175% by 2030, require roughly 720 billion for grid investment. In phase 1, rapid data center expansion leading connection queue emerge and projects are delayed. And in phase 2, limit grid capability, reduce supply flexibility, and increasing reliance on high-cost generation and pushing price higher. And this is already visible in the PGM market. And in phase 3, the effects slip over into the economy. Higher electricity price increase inflation pressure and the interest rate, while raising energy costs weaken the farm cash flow and increase credit risk.
Scenario 3 is a cyber and model shock, which is an internal bank failure. Phase 1 is the AI model drift, which means the world changes, but the model doesn't keep up, so it starts missing fraud or blocking the wrong payments. The result is immediate, with payment failure spiking and teams switching to manual processing. Phase 2 is the confidence shock. Once the news goes public, corporate clients pull balances, and retail outflows also follow slowly. This is where the funding tightens and the liquidity buffer gets used up. Phase 3 is the market reaction. Due to uncertainty, volatility jumps and FX options get more expensive. Regulators then step in and can force a remediation program. The key variables we track to make this scenario measurable are then explained. Finally, coming to the risk profile changes. First, it's operational risk, the outage, service disruption, and fraud losses. That then triggers liquidity risk because clients pull balances and funding tightens. Finally, market risk shows up through volatility, so our FX options feel it through mark to market hits and higher hedging costs. Now, coming to the scenario comparison, scenario 1 starts in markets, a valuation repricing. It builds over years, then snaps, so the bank faces market risk, credit risk, and interest rate risk. Scenario 2 starts in the real economy. The grid can't keep up with the AI power demand. It's slower and structural, so the bank mainly faces credit risk plus market risk and a climate or regulatory overlay. Scenario 3 starts inside the bank, a cyber or model incident. It hits fast, usually days to weeks, and the tail lasts. So it's operational risk first, then liquidity risk through outflows, and then market risk through volatility, impacting the FX options and rates desks.
We propose the following instruments to hedge relevant risks. For interest rate and ALM risks, the foundational hedge is a fixed receive floating interest rate swap, directly closing the earnings gap between our fixed rate loan book and floating rate funding, which is the same mismatch that destroyed Silicon Valley Bank. Due to the time and uncertainty, we supplement this with a payer swaption. For FX risks, we separate two exposures: a USD put to protect against directional weaknesses from AI equity corrections, and a long FX strangle that allows to profit from volatility spikes regardless of the direction. Beyond derivatives, loan syndication prevents concentration from building at origination, and term notes and cover bonds diversify funding away from AI tech deposits. We propose five key risk indicators that flow directly from the scenarios we just presented. The first two monitor credit risks from two perspectives. Concentration tracks how large the AI exposure has become, while DCCR deterioration signals whether borrowers are on the strain right now. The third provides an early market signal when AI equity multiples run well above the sector average. The fourth monitors AI incident frequency, tracking potential proximity to a scenario 3 event. And the last, it's about preventing AI tech deposit concentration to turn a confidence shock into an acute liquidity crisis.
Risk identification and hedging are only as good as the governance structure behind them. Here, the first line includes corporate lending, trading, and treasury because they originate exposure and should take the immediate actions. Lending should impose limits on AI and data center borrowers and monitor repayment capacity, while trading should de risk exposure to overstretched AI linked assets, and Treasury should monitor refinancing pressure as rates remain higher for longer. Then the second line, risk management, oversees the first line and should then challenge the business through stress testing, concentration monitoring, and model governance. Then the third line is the internal audit, which should assess whether these controls and mechanisms are actually functioning effectively. And across all three, the risk committee represents the escalation body that tightens limits, adjusts risk appetite, and approves the response actions. The final question is whether AI risk is systemic or simply sector specific. Using the course definition, systemic risk refers to shocks that propagate across institutions and markets and impact the broader economy. We assess this through four lenses. First, concentration. The AI value chain depends on key bottlenecks such as TSMC and ASML, meaning a disruption at a small number of points can affect the entire ecosystem simultaneously. Second, interconnectedness. Banks, asset managers, pension funds, and insurers all hold correlated exposure to the same AI linked firms. So, repricing occurs across the system at the same time rather than sequentially. Third, pro-cyclicity. As shown in our cascade, a valuation shock can trigger widening spreads, margin calls, and forced sellings, which can reinforce the downturn. And finally, opacity. If AI models used in risk measurement fail silently, institutions may underestimate a risk precisely when accuracy is most critical. So, overall, under correlated stress, AI becomes systemic, not as a technical issue, but as a channel for financial contagion.